Now we're on video number 5, and this video is going to get into how I view the market throughout the day. I've showed you how to read charts on the basis of how I read them. I've showed you locations and information of how reactions occur. Now, beyond what I've shown you, there are other options that you have as a trader. Certainly, you may have your own tools and ideas that you layer on top of mine. You may use measured moves, and so you add those to the formula. Or you may use certain indicators. I find stochastics is, if you're in a trading range, stochastics is one of the best indicators if you're going to use indicators. So you can layer that, add that to the formula, and match it with trend, and match it with gaps, and match it with the other tools, and develop a trade signal. Now, for a computer setup, I use 6 screens to view the market, but it's not necessary. I use 6 24-inch monitors. What is most important is, if you're an active trader, is that you keep up some of mini charts on a screen or two that show the stocks you're watching. So if you're watching specifically positions you own or stocks you're looking to enter, you leave them up there on an hourly time frame, and you watch and see as patterns and setups develop, and you learn to spot those reactions. The sooner you start watching like this, the sooner you start to see real reactions, rejections, fake outs or shakeouts or breakouts, and you start to get used to viewing this behavior. Now, those of you here that are watching this, that are more the investor type, well, you can use the simplicity of this method. Simply wait for your trend line alert to go off. It breaks, it shakes people out, and you enter in for potentially months to ride the trend. And your trend line defends you all the way up or down. But if you're active, I suggest having the charts open for those stocks that you're watching closely. Now, here's one screen of my 6. And you'll notice that some of the bars here look very strange. This is the TNA, which is the Russell ETF, the ES, and the NQ futures running 24 hours a day. And you'll notice I even show a 21 or 20-day moving average here. There's a red line on some of these that show the 200-day. I like to leave the 20-day or 21-day on the chart because it shows that reversion. As price extends away from that moving average, it tells me some information of don't go there, or it's extended, or it could reverse. It also tells me a slope, so it tells me if I'm fighting a current move. You'll notice if I point to this chart, this move on the TNA, the slope of the moving average is down. And as price gets further and further away from it, it reverses. Same thing here. This is kind of balanced. Remember, reversion means that price will revert back very often to this moving average. I believe that was caused, as I told you before, by John Bollinger making this popular, the Bollinger Bands. And their center is the 20-day moving average. But you'll see price goes to the other side. It rounds out the top far away from the moving average, which is flat, and now it comes down, which it can keep coming down and go and roll sideways. Now, as this angle tightens up and goes stronger up, as it starts to move up, and we see the slope go up, it can also serve as support. It's a flexible trend line. Now, you'll notice 3 charts here are not like what you're used to me showing in those other charts. These are point and figure charts. They are not necessary, but if your platform has them, the one benefit of them is they show support and resistance even clearer than what we see in this chart. See, this chart has jagged edges and extremes and pokes. This just shows exactly where the edge is, exactly where the top edge is. In fact, you can see the fake right here, the breakout failure. 2 peaks, it breaks through right here, and it fails. This was actually the short. I messed up on this recent move down for November. I saw this signal and I didn't react. There was a trend line break, this angle right here, broke and had a breakout. It made it over this double top under high low. This was a double top under the high. It made it over the top just barely. It saw daylight and shot down. This was a short to the point of here, which you cover some, and now it's just fallen apart. Same thing here, S&P E-minis. Why do I like this? Beautiful triangle line. You can see it right here. Uptrend line, pivot 2, breaks here. This is a breakout of this pattern, and it fell down. So it is the same chart as this one. They're the same, but the difference is I can sometimes more clearly identify support and resistance and pattern. So I use both. You can use a point and figure chart. You don't have to. It's just another way of visualizing the same information. Next one, these are mini charts. Same concept, but these are charts I'm watching at this moment. So if I'm watching Yelp in this case, you'll see the stock symbols on the top corner. These are 60-minute charts. Yelp, ACIA, Amazon, Twilio, TQQQ, Goldman Sachs, Netflix, DVMT. These are stocks I'm watching right now, so this gives me a picture of what's developing in real time. I like to keep these up. You'll notice I haven't drawn any trend lines on these or added anything. It's because I see the things that I've showed you in this class very often without drawing them. I see a wedge right here. One bottoming support line, 2 pivots, bottoming support line, coming down to the third. I see the trend line without having to be, drawn. I see in here a lowercase h. You see the down and then a rolling over rounded little h. So probably going lower here. I see a trend line here on the peaks. I see a lot of the data that the chart is trying to tell me without having to draw it. Now, sometimes I'll draw it if I have a position, but I also like to keep that 20 on. It gives me information. As price gets far away, it plays catch up with this moving average. I like it how it shows me so clearly here that this is a downtrend and reminds me, don't try to go long so easy here. This thing isn't flat. It's shooting nearly, a sharp angle down. I don't want to necessarily fight that trend line angle that is telling me it's still very strong to the downside. The nice thing about the moving average is it's an eye helper. When that line starts to get flat, I know the odds improve that my long will work. But when it's shooting down like this, I know that pops will be sold. Look at this one here. Moving average is coming down. It goes above it, turns. Goes above it, turns. Spikes above it, shoots down. The angle here is down. It's reminding me that this is hard right now. Here, Amazon. This was actually a trade I blew live in the chat room. I like to screw up every once in a while just in front of 400 or 500 people. And I said when the gap down happened on Amazon, when it goes to retest 800, it's going to have a problem. That's a century mark. If you drew your topping resistance line, 1 peak, 2 peaks, that gave you the top, that gave you the resistance of the 800 century mark. You have a moving average screaming down, you short here, and right now this trend line is keeping you short until such time as you have to cover when it breaks the downtrend line or it tells you you're wrong. So I use, one of my screens always has this, sometimes 2 of my screens have mini charts like this to watch the behavior. Look at Netflix right here, bear flag. Doesn't mean that it'll work. The failure is if the bear flag fails and goes above the pattern here. That would be a bear flag failure. Now, that leads me to a hint for those who are listening. If you're listening and you've been paying attention, I mentioned that failures before are important, and they are because failures often create stronger moves than successes of a pattern. So I want you to think about something, and that is when you're buying a weaker stock, rather than trying to go long a reversal of some strong signal, which in a weak stock, strong signals are failing 90% of the time. Think about it. That's exactly what they want to do. They bring bulls in, they get them to think they're actually going to catch a low in a bad move, and they trap them, and suckers game, they shoot it back down and take their money. So when I'm trading a weaker stock, I'm looking for a failure of a pattern, not the success of a bullish pattern, but a failure of the bears to prove that they're strong enough to break lower. In this case, in Netflix, this stock is relatively strong right now. It had good earnings, but it has this bearish pattern. The market is difficult right now. So maybe I don't short this pattern because I don't have the risk reward and I'm not doing a breakout when the market is oversold. But maybe it takes out the high and breaks out of the bear flag. In essence, think about the psychology. The bears had too little power to break down out of the pattern. The pattern fails and it cracks to the upside, thereby providing a bullish signal without being obvious to bulls. This is a safer spot for me to initiate. For those of you who saw me trade Twitter, which was a weak stock, and I was successful playing weakness in that stock because I understood it, I never bought one bullish signal in the stock. I bought failed bearish patterns. I waited until they made an ugly bear flag, got everybody underneath the pattern, and it was a shakeout. It would fake to the underside and then immediately snap back hard. And I bought those failed patterns, saying to myself, look, bears are at a support point. They're supposed to show their power here, and they didn't. So I'm going to go the opposite direction and use the failure to catch the snap up. If I had used a bull flag in Twitter, a weak stock, they would have done what they did to the last 10,000 bulls, which is eat them alive. So failures of patterns, failures are a strength to me. And yes, I trade failures as much as I do successes of a pattern. Next screen. Here's how I watch indexes along with the other view I showed you. We know that moving averages have some value because traders watch them. The 200-day, which is in red, the 50-day, which is in yellow, the 21 or 20-day, which is in fuchsia, the 10-day, which is in, I believe the 10-day is the blue here, and I don't know what that other gray line is, but I don't use it, so I think there's just, I made a mistake in leaving it in there, but I don't use that. Now, I view the TNA, which is the Russell, the NASDAQ, and the S&P. Those are three indexes that I always have my eye on. In the case of this last low, I'm not showing the chart that it bounced, the 200-day on the SPX was the bounce area. So I keep these open to just look over and see where those lines are at and what I see on the daily. This tool I don't use much, but it's called volume spread, and it is looking at the difference of volume up and down on the S&P. I have to admit I don't really use it, but some people will say when you see volume coming to the upside and it's climbing, it's bullish, and when it's falling, it's bearish. I don't use it even though I have it on my chart. I'll probably utilize it more soon. Here is the UVXY. I talk about the VIX always when I'm trading indexes. And the reason why is simple. Forget the pattern on the VIX. Forget what it looks like on a pattern basis or what the price is. I strictly use it as an indicator of the turns that are happening in the indexes. If price is at the top of the range and it's climbing and the VIX is very low, that's fine. But if the VIX starts to rally, I know fear is starting. A reversal may form. Conversely, if we're at the low and we're screaming down and the VIX has a strong pattern and then falls apart It's an indication to me that we're about to see an attempt to leave the bottom, to reverse. Fear is falling. That's all I use it for. So I talk about it a lot in chat. Now this tool right here, I do use a lot. It reminds me each day, what are the number of 52-week high stocks, meaning reaching a new one-year high, and the number of stocks that are hitting 52-week lows. You'll notice recently when the market was peaking, we had over 700 stocks that were hitting new highs. Now we have under 100 down here as the market's falling apart, but we have a lot more hitting 52-week lows. I look at this where these become extreme, telling me the market is a little overheated, too excited, emotion is high. And the same thing is over here. When this spikes like this, it gives me a clue there may be a reversal soon. There's too many that are bearish. So I look at this kind of once a day just to see. Now, this is my watch list for indexes and key sector information as well as over here. So you'll notice I have a couple of fields here that may not make sense to you, but I'm going to explain them. In the case here, you'll see this is the symbol. The next is the last price, the net change, and the net change percentage. Then you'll see this field that says range. Now I want you to imagine what this field is. The range is the percentage of the bar from high to low that the bar is sitting at. So I want you to understand I can visualize what the bar looks like without even opening the chart. In the case of TLT, it's at 92.42% at this moment when this chart is cut. That means it's not near the low of the bar, it's right near the high. It's like less than 8% from the high of that bar. Conversely, on the other side, TBT is at 2.86%. So that means if you looked at the bar right now, if we open up that chart, TBT is trading like literally right off the low, like just fractions off the low. If we looked at UWTI, which is oil, at this moment, the bar is at 50%. It's a doji. The high and the low are separated and it's sitting in the center. Now, why do I use this? Well, it's kind of an edge where I see the market is in poor behavior off the open. But I see what's climbed up in order at the high. I can tell you what is relatively stronger than the rest of the stocks. If the market is really strong and think some stocks are trading on the lows, I can instantly see what sector or stocks those are. And I've gotten used to knowing the sectors, so I know what stocks are in what sector. This range of bar tells me a quick way to identify what the bar looks like. Now, you may not understand this edge yet, but imagine that the market is really strong and you're trying to figure out where they're going to at the highs, which ones are just banging through highs. This would be at 100 or 99 or 95. And even in the middle of the day during lunch when they all pull back, if you want to find the more relative strong name, well, its pullback will not be as deep. While rest of the stocks will be down at 30 and 40 and 50% of the bar, this one will be sitting at 70s and 80s. It's stronger than the rest. So it tells me what is strong. Now, next to that is volume that I look at, and this volume is a simple percent. I want you to think about what it's telling me. In this case, it's telling me at this moment on IWM, volume is 141% of the 21 or 20-day average. So in essence, this is 41% over normal for the end of the day when I cut this. Now, in the case of intraday, it also is giving me clues of how fast volume is coming in. If I see the, let's say, oil is trading, UWTI is a triple long, and the volume in this case is at 80% in the first 40 minutes of the day, I don't have to do much math in my head to say, this thing is done 80% of a normal day, and it's only an hour or 2 hours into the day. this thing's going to be massive volume today. And in the case of this day, when I cut the chart, oil was down on 100 and nearly 180% volume. This percentage is a quick way for me to see which ones have the most amount of volume. Now, you'll notice two with zeros because these don't have volume that reports. But if they have volume that reports, when I'm looking at the ones at the high of the day, using this range percentage bar, I will look over and see the volume. And if the stock is at 25% and it's 6 minutes into the day, I know to focus and notice that spot. Same thing over on this one. I break up the sectors into these XLF, XLE, all of these ETFs. When I look at the day and I open up and try to see what's going on, I can see by their range percentage which stocks and indexes are rallied to the highs. If the market is at its lows and I'm seeing that they're at the highs on, let's say, XLU, which is utilities, I know they're running to utilities because that's safety. And so I'll look at that volume and see the massive demand or what's happening on that, and I'll be able to understand the day better. In the case of this day, they were buying the biotechs more than average, 26% over average. You'll notice there's a field called end of day volume. This tool is a little bit different than this one. This one is estimating real time during the day what the number will be at the end of the day for volume. It estimates that this was going to be 126%, and it adjusts throughout the day. So I can see, in this case, Goldman Sachs, 45% of the bar. That means it's almost a doji, the middle of the bar. A doji is where you have a wick on the top and a wick on the bottom, and the closes in the center. It signifies indecision. Nobody knows at this moment. It's unclear. But you'll see, in this case, Goldman Sachs is almost a doji and on lower volume. Now, why does lower volume matter? Well, in the case of some of these, when they pull back, I'd like to see that number be very low. Here's an example of the S&P 500 top 50 stocks closing at the low of the day, 1.23%. Low of the day close, 51% volume estimate at the end of the day. Half of normal volume. That's no selling. That's very little pressure on that name. You'll also notice I have the tick. Now, a lot of people use the tick to determine if there's positive ticks or negative ticks, as stocks are positive ticking or negative ticking in the market. And it's looking at all the stocks in the NYSE. I have to admit, it's on my chart and I don't even look at this. I look at this. This is advances minus decliners in stocks. Advancers minus decliners. And you'll notice there's a moving average on here, which you can set your own, put on a 10-day or a 20-day. It's actually a 10 bar or a 20 bar because this is a 1-minute chart. But the idea of what this is doing is, if we're on the lows and I start to see the moving average curl up and starting to climb, I know that buyers are coming in to the market. So it shows me there's more stocks getting more stocks are getting an uptick than stocks that are getting a downtick. Conversely, if I start to see it dropping like it does here, and the moving average is above that cyan line, it's telling me that there are more stocks downticking than upticking. And so it's just a helper for me to understand where stocks are going to, where there's more pressure one direction or the other. Very simple tool. You can set it up on your platform, simply putting up the advancers minus the decliners on whatever your platform is. You'll have to call your platform provider and ask them what the symbol is if they can do it. And then put a moving average on it and simply say to yourself, if it's above and it's climbing the hill, I know there's more stocks ticking up than ticking down. It tells me the market is generally pushing one direction. This is helpful when we make a turn. I like to see, when I call the turn, that I like to see stocks are climbing that new mountain in a new direction. If it stalls out and I start to see it go back under and it's falling away, It's telling me more stocks are ticking down, which means this isn't a strong bounce. Pretty simple. Next one is my quote screen. My quote screen is very simple. It's the same information we looked at on this last example. My quote screen is the same as what we just discussed, but I'm going to add a layer and actually show you an indicator so you can see they can be used. I dedicate one screen to quotes. It may sometimes have two columns here and a smaller chart, but I want to show you how I use this, and sometimes I put this in here. I don't usually have this on here, but I want to show you an indicator and how it's used. Here's the symbol. I will sometimes have groups of symbol. If I own 4 symbols at this moment, I'll group them together so I know to watch them. And you have your last price, your net change, your percentage of net change, and here's your volume simple. Remember, this is quickly telling me the percentage volume. So I have it gradient. It goes from black to light yellow all the way to bright yellow as the number goes up. Some platforms do this, some platforms don't. The idea is I can actually see by ordering this by the range of the bar. Etsy was at 87.76% of the bar when I took this shot. TWLO was trading at nearly the exact low of day when I took this shot. But I can instantly see which ones turn from black square to yellow as these start to come off the page of showing high volume. And so I'll look in the morning to see what stocks are acting strong, and then I'll see which ones gradients start coming up in color as the volume is shown. The first ones to show high volume and strong price action, I know those may be potential longs. If the market is weak and I see a lot of selling, the bar may be at the low of the day, heavy volume. I may notice that volume early. Let's say Twilio is at 30% in the first 5 minutes and it's at the low of the day. I may say, there's a stock I need to look at and see if a pattern's about to break out because it's acting awful, terrible behavior. So that is how I use my watch list. This is strictly the volume count number. I have to admit the only reason I keep that up there is because if it's first thing in the morning, like at the moment when price is gapping before the market opens, I can see how many shares. I see people in the chat get all excited. They'll say, oh, my stock is up $3. And I'll look over at the volume and it'll be 312 shares. That is not a gap up. That is a painted gap up. That is beautiful for psyching people out, but a real gap requires thousands and thousands of shares. Now, of course, if the stock only trades 3,000 a day, which is non-existent, but if it did, well, then 300 shares matter. But if the stock trades 10 million shares a day and you see 4,000 shares, a gap up for $3, it may not be real. Don't get yourself psyched. You need to see volume matching the gap or volume confirming that somebody else believes it. Now, you'll notice my price bars, same thing. You don't see the white closes here because they're not as defined, but they're important to me. The closes is the most important thing. Strong markets close higher. They may open lower, they may gap down, but they close higher, stronger in the bar. And weak markets just love to gap higher and close lower. So the close is where pros had the most control. The close is the most critical to the bar. You'll notice I left the 20 on here. You remember when I said when price is sideways, the 20 is a reversion tool. And John Bollinger created the Bollinger Bands, and it highlighted this issue. Well, here's an example. Price is caught between this trading range, this base, and it swings from one side above the 20 to the other side. Swings above it to the other side. This is balancing like a balancing beam across the 20 moving average. Now, I gave you a stochastics indicator. It is not something that I use consistently. I put this on so I could explain how it can be used. So let's say you have all your other tools in a row. Your ducks are in a row, you understand how to read price, and you're caught in a trading range. Oscillators and indicators like this do well in a trading range. They do poorly in a trend. And the reason is simple. They get pinned on one side or the other when price trends. Nothing is faster than price. That is why I love price. Everything that is a derivative of price is much slower. So when you look at a 21-day moving average, it's 21 times slower than the actual price. We need to know that when we look at tools. In the case of this one, when price is in a range, you'll notice it highlights the top area, the bottom area, the top area, the bottom area, the top area, the bottom area. It generally gives good signals in a range. Where you will get decimated and lose using indicators is then when it starts to trend. It'll be down here looking like it's going to turn, and it'll just keep going and keep going, and you will have been mauled trying to use a tool that will be pinned down here or pinned to the upside in an uptrend. That's why we have to be careful. Now on the right-hand side, I have something a little bit differently. I take the universe of stocks that exist out there, and I limit the universe to only stocks that I would consider. So I've done a scan out there and I say anything that trades over 800,000 shares a day, because I don't want stuff that's too thin. Anything over 800,000 shares a day that has, let's say, a range of more than 40 cents. It moves more than 40 cents a day. There's an indicator called ATR that allows you to tell how many days on average over the last X number of days that the stock normally moves. And I throw them all in one watch list. And I throw up the tool that's called end of day volume in this case. And it's estimating what the volume is. And so what the benefit of this is, let's say the day opens, and in 5 minutes or so I look over and it tells me what stocks have very high volume, and I can look at their price to see what's going on. This is how I sometimes find some of my stronger names to trade. I will look over and see GIMO is doing 8 times normal volume. There's some earnings report or something, and I will look over, I will look at the chart, and I'll go, yeah, this is doing 3 things here that I understand. I'll take along. It also tells me what's going on with the market. Remember, the longer you do this, the more you know what the sectors and stocks are. I see Whole Foods up there right now. I see, multiple stocks, SYMC, which is Symantec. I see names, ACHN, Bio. I see NTAP. I see, EOG. We got oil and gas names. And the end result of this information is if I see 3 of them that are all strong, if I see 3 of them at the top on massive volume moving, let's say, in one sector, like bios, it gives me information that I know that's hot today. It's another tool to tell where the herd is going. If we notice that there's incredibly weak days on multiple stocks and they're on huge volume, it's telling you that sector is under pressure. I certainly wouldn't be trying longs on that sector that day. So that is what I'm looking for out of that. It's almost like a built-in scanner for me. Now here is where I actually do scan. Every single morning, I like to scan for, if you see at the top here, there are 3 scans in this software, and one of them is a gap trend. So it will gap in the direction of the trend, and I will notice those, or gap under the lows. This is a good one as well, where price will be gapping under the prior day's low. Remember, we talked about screw bars. I'll then go and look at those charts and say, hey, this one closed big up day, and then the open, the gap is going to be below the low of that bar. I know everybody is trapped. I want to look those over to see if I have reason to trade them. Pre-gap simply means show me all the stocks gapping pre-market. Why? Because I'm going to put them in order over here and look at their volume and look at what they've changed and what the symbols are. And I'm going to click on each one and look at the chart to see, are any of these gaps valuable? Are they gapping major support? Are they gapping major resistance? What other layers or confluences I have that this one open, this flip that happens from the gap could start a stampede? That's the reason. Next slide. This is how I use a program called TC2000. The only reason I use this program, I have to admit, most important, although it has another function I'm going to show you, is when you set an alert on a trend line in TC2000, it will send you a text alert without the program open. In my TradeStation, if I set a trend line alert, I need to open a workspace and throw all of those trend line alert charts in there because the program needs to be open and the chart needs to be open for the line alert to trigger. That's a royal pain. If you've got 150 different stocks with alerts, that means there's 150 charts using resources that are real-time changing data on your screen somewhere hidden. Maybe they're not in your view, but they're having to collect data to keep getting ready for that cross. TradeStation does not allow me to do that. In the case of TC2000, for less than $100 a month, I believe, I can put in the trend line alert, set the time frame for the next year, whatever it is, and when the alert hits, look at the stock and determine, do I want to invest or do I want to trade? What do I want to do based on what reason I set that alert? Now, I don't trade through TC2000. I tend to trade through Fidelity or Interactive Brokers, which has a horrible platform in my opinion, but great fills and good cheap commissions. I tend to trade a little bit through TradeStation, very small, but realistically, these are platforms to read the market. And yes, the better you're doing, the more you should definitely have the right tools. But tools are a joke when it comes to creating skill. When I first started, I bought every trading platform known to man. I had to have Dan's eSignal. Its eSignal is no different than TradeStation. There are strengths and weaknesses, but I had to have it because Dan had it. I was wasting money on spending for a more expensive platform, but I didn't care. I thought that was going to be the difference that improved my trading. I was dead wrong. It wouldn't have mattered. Nothing was going to help me at that point. I wasn't thinking right. I'm not a fan of certain tools and web charts and things like that. I want better quality. If you're doing well, you can do well on pretty weak tools. But if you have the greatest tools, you're not going to do well if you're not trading properly. So I had bought multi-charts for $1,500. I had spent $1,500 on NinjaTrader. I spent money on every toy and tool, and none of them changed my trading, but a change in my ability to read the market. The only reason I reference this tool, I'm not getting paid a commission, I'm not working for TC2000, I just like the trend line alerts that I can put any angle on the chart and it will warn me when it crosses or touches that. Now I also use TC2000 for one other thing. I don't love their charts. If you look at it now, I don't think they're more clear or more defined than what we saw before. In fact, I find them a little more hazy and difficult on the eye. But they have a tool in here that allows you to look at industries. And I'll often scan, not per se scan, but I'll look at each one of these industry indexes. And then I'll look at the components in the indexes to see what's going on. So I'm on copper right now, and copper's been getting stronger. You'll notice that there's a descending line here, and copper is over the 200-day now, this red line, and it made kind of a double bottom area, and it broke the trend line, and it's kind of climbing up. We're seeing a little bit more strength here in copper. So I will look at the components of copper. In this case, the largest component looks like with 27 million shares a day, or at least on this day, 27 million shares, was FCX. So I'll look and see what's going on in those components. Now, if the sector's really strong, I'll trade the strongest names in that group. So if they're running copper, I will try to look at that name. I may not trade it if I can't find layers, but I'm going to look at that group because market and sector has more to do with the stock's success than the individual name. If you have the best name in the entire sector, but the sector is being sold off, let me tell you that professional money will throw the baby out with the bathwater. They will unload some of it just in the normal course of getting rid of stocks in that group. So I don't try to pick the one that is the outlier. of all of them. That's how I use another feature in TC2000. There are several conditions that I look for in scans, and there's a reason for them. I look for large gaps. Why? Because even pros have been fooled on a large gap. Often, professional money is fooled when a large gap occurs. They got the story wrong. They understood it wrong. Their analysts didn't get the figures right. So a large gap means people are underinvested or they're too heavily invested in a gap down. And so a move can come from that. I track those. Weeks afterwards, I may be still looking at that symbol. Gap flips. I already told you in the morning. If it's gapping and flipping an exact high of a bar that was a, resistance area, I'm interested in looking at that name. I need more reasons, but I'm looking at that name. Screw bars. If screw bars are the reversal of one strong bar or one weak bar doing the exact opposite on the next gap day, fantastic. I'll screen for those. I screen or scan for the strongest stocks. So I will look and see what strong stocks are existing in a market. Right now, the market is pulled back. We're off the highs. And Netflix gapped on earnings, so it's strong. And GIMO is strong. And NVIDIA is still strong. And AVXS, I believe, is still strong. And MOMO, MOMO, is still strong. So I will focus on those. I'll also look at what is the weakest stocks. Why? Because I want to see where there's pressure to the downside. Maybe it's giving me a clue about the conditions of the market. The longer you're in the market, you start to learn that certain sectors indicate where you are in the cycle. If people see utilities flying and there's a lot of strength in utilities, that generally means that fund managers and professionals may be moving towards safety. You're not going to lose generally holding on to a power company or a utility. These are not growth companies. These are safe venues to put your cash where you make a tiny dividend and they're going to be there tomorrow. And they're going to leave their Amazon and knowing that that's a high beta stock, meaning it can move big. They're going to slow down their portfolio and step away from that one maybe, keep a smaller position and move more cash toward that safe venue, that location where they're not going to worry. Look, in the top of a market when it's most excited, often you'll see that cigarettes and beer, and there'll be money moving to safer things like toilet paper. And this is a sign that they're looking for places to store cash where they're not going to get hurt. And that's a smart idea as the volatility increases. On the bottom of a market, when those utilities have been doing well and stocks have been safety that we find, you'll start to see tech coming out, and those will get volume and interest early. And that's because those stronger stocks matter. So by looking at the strongest stocks, even in the middle of a bear market, I'm getting an indication of where they may be going first. I'll also look at huge volume. Why do I do that? Why do I do that? It's because huge volume, huge interest is what that shows. Maybe indicating to me there's some change in condition. When those steel stocks started to run, there was a change because of tariffs. I didn't know the news, but I did see the huge volume in multiple names, which told me something was going on in steel. I read price and it gave me a trade. Now, I always scan for M bottoms. We talked about M bottoms. That's one of my favorite patterns. I will look for those because they give me early entries into a potential big trend, and an investor should definitely look at those. And then back tests. I will look at every trade, especially the recent breakouts, where our chat room is complaining that maybe the stock didn't work or it's failing. And I will specifically look at those so that I can see, can I buy the higher low above the breakout while they're jettisoning the stock from their account, while they're purging the stock and puking up shares. I will look, can I buy it there as it's holding up above the breakout? that is often a way that I'm able to get in when other people are getting out. That concludes this video. I have given you an enormous amount of educational materials over the last 6.5 hours of watching. It will take many views to actually absorb and understand what I have presented here. But as you do that, I will be around for questions, and the entire group will be able to see those answers using Twitter. So you'll type in your question to me on Twitter, and I will answer with an image or video content that everyone in the group can see and learn from. While I'm here, still in the webinar, if you're still here generally until probably 6 p.m. tonight, Eastern Standard Time, you can type in a question there and I'll be happy to answer. But there was more content to give you than I could even fit in this day. And there's still more to release after today. So I'm wishing you good luck on studying and good trading.